You know, again, I'd also like to thank our event sponsors and the starting off with RBC Wealth Management, who's the sponsor for the luncheon today and sponsoring our keynote event. I want to thank Brad Fisher for that. This has been the 7th year I think you've done that, Brad, so thank you. Also recognizing KNDU and the Tri-City Herald for their media partnerships, Pro-I Audio Services, for their contribution, Benton PUD, Mission Support Alliance, Charter Communications for filming today's presentation, and of course Cadillac Regional Medical Center, who's been our presenting sponsor for, I think now 10 years. I want to thank Rand, Lane, and Wayne all for your contribution to this event. So thank you. Clearly, I think many of you know that without our sponsors, we can't put on the kind of program that you saw this morning, the kind of lunch you're having today, and that sort of thing. So, again, thank you very much to our sponsors. So, RBC Wealth Management, a division of the Royal Bank of Canada, has been assisting clients with their investment needs since 1909. Today, the firm is recognized as one of the world's top 10 largest wealth managers by assets. Locally, RBC is located in the Spalding Business Park at the Richland Y, and the office opened in 2006 with 5 employees, and they've grown to 13 currently. The local branch director, I think most of you know, is Brad Fisher, and he's been in that role since July of 2006, and prior to that time, he was the financial advisor and branch office manager for Piper Jaffray for apparently 15 years. You don't look that old, Brad. Not at all. Brad's a native Tri-Citian, has been active, involved in the community. He's a former mayor and councilman for the city of Kennewick. He presently serves as a member of the advisory council for WSU Tri-Cities and is a former chair of that advisory council. And he's a member of the Tridec Board of Directors and on the Tridec Executive Committee. And finally, a member of the Tri-Cities Evolution, which is a local governance task force. So please welcome Brad Fisher to introduce today's keynote speaker. Brad, thank you.
Thank you, Carl, and good afternoon. On behalf of my colleagues at RBC Wealth Management, we're pleased to provide the keynote presenter to you again this year. Our speaker hails from Boston, where he told us it was 4 below zero yesterday when he left the airport. Welcome to the balmy Tri-Cities. He is an investment officer and institutional portfolio manager at MFS Investment Management, where he serves as a member of the U.S. Equity Growth Team, participates in the research process and strategy discussions, assesses portfolio risk, customizes portfolios to client objectives and guidelines, and manages daily cash flows. His firm's flagship mutual fund, Massachusetts Investors Trust, or MIT, is the nation's first mutual fund, having been established in 1924. He is a graduate of the University of Massachusetts at Amherst and earned his Master's of Science degree in Finance from the Sawyer School of Management at Suffolk University. For his perspective on where we are now with the markets and the economy, and more importantly, where we are headed and why, please welcome Rob Almeida.
Thank you. Good afternoon. Well, thank you, Brad. Thank you, Carl. Thank you, everyone at Tridec, for having me here this afternoon. I appreciate it very, very much. As Brad mentioned, I left Boston yesterday. It was literally -4 degrees. I called my wife this morning thinking it would be a little bit improved. Apparently, there's a massive cold spell breaking through the Northeast. I think it was like -6 when I spoke to her. So I'm very, very happy to be here for a number of reasons. So my objective, what I was assigned to do this afternoon, is to present to you and share with you our thoughts on where we are in the economic and market cycle. And I'll maybe jump off a platform that Patrick, the prior speaker, provided when talking about making prognostications. Extremely difficult to do, particularly in areas of social science. So what I've learned about your community and your area, with all the science and technology and innovation, there's a huge and vast difference from my perspective between what I would consider markets, economics, to be a social science, and even that's giving it some, maybe a little bit of a stretch even to have the term science in there. The market's a discounting mechanism of all available information. So bulls are pulling the market this way, and bears are pulling the market this way. And every moment of the trading day, as stock prices are clearing, the market's telling you. It's collective and aggregate views about where risky assets should be priced. Conversely, when you think about hard science, and I'm not a scientist, so I'm probably going to butcher this, but when you think about Newtonian physics, or force equals mass times velocity or acceleration, or some derivative of that, there are things that you can test in a laboratory, like many of you do, or many of your peers, or colleagues, or friends do on a daily basis. So I can take this little remote control, throw it against the wall, and we know exactly what's going to happen. But in markets and economics, you can't. It's much, much harder to do. So should the Fed be raising interest rates next month? Should they have raised interest rates last month? The only correct answer to that is time will tell you. Right? You can't test these things in a lab. So in forums such as this, in events and discussions, dialogues like this surrounding market views, I think it's important to always understand the speaker's bias, particularly, again, when you're talking about social science and you talk about market views. What's the speaker's bias? So let me share with you my bias. So as Brad described, I grew up, or I'm from the Boston area. I'm 45 years old. I spent my whole career there, with the exception of a couple of silly years after college that we won't talk about. And I've spent my entire professional career, which is, so this is my 20th, yes, this is my 20th year in the business. So my entire life has been spent largely in the Northeast. My entire career has been in capital markets, largely for buy-side active managers like my own. And so what that should mean for you is I'm a pretty cynical and miserable person. I'm trained to look at the world to see what's wrong with it versus what's right with it. Because when you think about an investment, whether you're lending money to a municipality, so you're buying Washington state bonds, let's say, for example, or you're buying U.S. Treasuries, or you're buying stock of a publicly traded company, or you're buying a restaurant, what have you. What matters ultimately to asset prices, and I'm going to get into this and it'll be the focus of my presentation, what matters is the future cash flow generating capabilities of the asset you're buying. But when it comes into investments, I would argue, at least in my career, there's an element of succeeding without failing. So as an investor, and you folks know this as independent business owners or just in your professional lives, you make mistakes along the way. You make a lot of mistakes. But I think what ultimately determines an individual or an entity between long-term success over time and the alternative are how bad were the mistakes that you made. And so as an investor, I'm always trying to think about what can possibly go wrong, and then risk weighting things in a portfolio. So anyway, before I get into all that, a little bit about my firm and, again, I guess my bias and what we do. So as Brad mentioned, my firm started in 1924. We launched the first mutual fund that year. Literally, the first mutual fund in the United States. It was innovated and produced by my firm. And part of the reason for it was nearly impossible for the average American to invest in the equity market over 90 years ago. Let me give you an example. So the average annual earnings for the everyday working Joe was somewhere between $1,500 and $2,000 a year. The average price of a large cap industrial stock 90 years ago, a name of a company that all of you know very well, you have their appliances very likely in your kitchen, traded for about $250 a share back then. You had railroads and other institutions whose stocks or equity values, the price tag was $300, $400 a share. So it was impossible, unless you were the top 1%ers, to invest in the capital markets back then. So we came along with what was then a very innovative way for investors to gain, one, access to the capital markets and do so in a diversified manner. So I represent an asset manager. We buy bonds, we buy stocks. And so what matters to me from an investment standpoint, and the core of my presentation this afternoon, is future cash flows, future profits. And how much are you paying for those future profits? So that's how I was trained. And so what I want to share with you, so the crux of my presentation this afternoon is titled Taking on the Market Narratives. And so what I want to address largely are what are the big market narratives? What are investors, what are you all concerned about? And I think the timing of this probably couldn't have been better. I doubt you perfectly timed this to have the worst start on a calendar year basis in the U.S. equity market's history. I'm guessing this event is more of an annual event to kickstart the new year. But from a market standpoint, from my participation, you couldn't have timed it any better. And so the market narrative, not just the last few weeks, and not just the last few months, but the market narrative the last really 5 or 6 years, shortly after the global financial crisis, and really the onset in the market recovery, has been largely twofold. The first is this assumption or belief, this misconceived notion that markets derive their value off of the U.S. economy. I think it was Corey's presentation earlier today that gave a great, at least I'll use as I think a great illustration as to why there is largely a non-existent or there isn't a relationship between economic growth and the return of the equity market. And I realize that sounds counterintuitive, and it sounds hard to digest, but think about the example that Corey used regarding Uber. And it's not just millennials that are using Uber. I use Uber quite a bit. Super easy, fast, convenient, clean, no cash, credit card goes, it's perfect. So Uber, rough estimate is anywhere today from a $40 to $50 billion market cap. So this company went from an idea 6, 7, 8 years ago, or whenever it was mentally incepted and physically started, to today being one of the largest, fastest growing private companies in America. And how was Uber's growth sourced? Was it sourced from population growth and business activity and more people taking taxi rides? Probably not, right? Because when you think about what economic activity has been, the improvements in the labor market the last 5 years, the pace of population growth, pretty benign, right? So Uber's growth was sourced at the expense of someone else. Right? That expense came from limo drivers, taxi cab drivers, etc. So from an investing standpoint, at least from my vantage point, what's less important is the future direction of GDP and economic activity. What's more important is profits. Who's making profits and who isn't? Now, there are certain companies and industries that are GDP sensitive and rely on economic activity. But as an investment standpoint, one of the biggest, and I'll show you in a moment, one of the biggest mistakes investors make is believing or investing based off a directional view of what they think economic growth will be. So we'll come to that in just a second. So here's how I decompose the presentation. I'll spend the bulk of the time addressing what I believe are two big market narratives. The second I already talked about, but the first is market at all-time highs. Just a quick piece of empirical information. The market goes up 74% of the time. So this has existed now for about 10 years, 20 years, 50 years, 75, 100, 150, 200, 250 years, and if we go back outside the U.S., it exists for 300 or 400 years. So markets go up 74% of the time. But the rhetoric or the narrative is markets are at all-time highs. So you turn on CNBC, Bloomberg TV, or maybe local news, and 3 months ago or 6 months ago, the market's breaking an all-time high. What's that? right? Flashing news, markets at all-time high. Well, as my 9-year-old would say, duh, it's always at all-time highs. So what's important is, again, the future cash flow that you're buying and how much you're paying for it. So let's get into it. Okay. All right, I love this slide. An economist, 7 standard deviations smarter than I wish I could be, named Charles Kindleberger, an MIT professor, many, many years ago, joined with another very, very smart economist named Hyman Minsky, came up with essentially a theorem, the results of a study that they did. And this was published in a book called Manias, Panics, and Crashes. Anyway, what these two economists set out to do was they wanted to source, how do these bubbles form? How does the bubble of 2008 form? How does the bubble of 1999 form? How does the bubble in the 1920s form? Right? How did the tulip crisis bubble 400 years? How did that form? How do these bubbles form? Are there anything that we can learn from it? Are there commonalities and common stages to these market bubbles? So I want to share with you their research in this simple output, and then I want you to think, at least in terms of what's going on around you, and where you think we are in the U.S. economy today, in the U.S. markets, where are we in these stages? So what these two individuals did was they looked back over the last 400 to 500 years at every single market melt up, bubble, right, and subsequent collapse. And they tried to collate and aggregate and then decompose it down into 5 simple stages, which I've showed you here in 2 different forms. So the one on the left, I'll start off with at the top of that little circle or circular graph called displacement. So displacement is stage 1. And what they are referring to here is the first stage, or inning 1, of an onset of a market bubble is the result of an exogenous shock. Now that exogenous shock is a large characterization for a lot of different things, but something that is pervasive and affects in a systematic way the broad economy. So think back in the 2004, 2005, 2006. What was the exogenous shock then? Well, hard to identify as to what was the key source to the housing bubble and the credit bubble. And there's a lot of fingers and pointing to go around. But just simplistically, easy credit. Super gross, easy credit. And those instruments, those credit instruments were turned into bonds that were packaged into portfolios that were then levered up by financial institutions, et cetera. That was the exogenous shock then. Think in the 1990s, the proliferation and the penetration of PCs. The revolution of the PC. PCs were suddenly going on every desktop across the world for office workers. Radicalized and changed the way office workers could function in terms of productivity. Think back to the 1920s. The electrification of the United States, probably the biggest exogenous shock. This exogenous shock creates huge expectations about profit making in some segment of the economy. So that's the first stage. Then the second stage that accompanies every single market melt up is what they call boom, which I'll refer to as simply leverage. Massive institutions, individuals, smart investors, institutions, however you want to describe it, start investing in this area of potential high growth. Right? Again, we saw that in the mid-2000s with banks lending money as fast as they could, and then other financial institutions then buying those bonds and leveraging those up, etc. You saw that in the 1990s with hedge funds leveraging up portfolios to buy anything with a .com or a .net on the end of it. You certainly saw that in the 1920s with probably the greatest leverage in the capital markets this country's ever seen. Stage 3 is my favorite. Stage 3, they nicely, or maybe in economist speak, refer to as euphoria. I'll describe this as there's nothing more painful than seeing someone you don't like get rich. Right? So that's that neighbor that you dislike, right, that leaves us Christmas lights on through February, starting to get extraordinarily wealthy. And you're at, I don't know, a party or somewhere, and you talk, what's Bob doing? Oh, he's investing in biotech stocks? He doesn't know anything about biotech. He's crushing it. He's killing it. Oh, John, what's he doing? Oh, he's flipping houses in Florida. Oh, God, should I do that too? So what happens in this phase is manic greed starts to set in. And investors shift from investing in an area that they expect is going to have profit growth, right? So you buy, I don't know, an apartment complex that you're going to rent out. You're buying it for the rental income. Or maybe you're buying a bond for the coupon. Or you're buying an equity for the upside appreciation, right? You're buying it for the profit growth, the cash flow, right? That's what investing is. It's about cash flows. Here at Stage 3 Euphoria, it's not about cash flows. It's just about buying something in the hopes of selling it to a bigger idiot than you down the road, right? That's what it's about. That's Stage 3 Euphoria. But I say use the term idiot jokingly. This happens to the brilliant people too. Sir Isaac Newton, in 1720, had 100% return in his shares of the South Sea Company. And somewhere between Stage 2 boom and Stage 3 euphoria, he sold that investment, and the stock continued to rise. So he went in and bought it back with leverage and lost 3 times more than what his initial return was. So I forget the exact quote, but he said something along the lines of, I can study the movement of heaven and earth and moving bodies, but I just cannot figure out the actions of people. Something, I'm bastardizing, but something along those lines. So it happens to everyone. But my point here is this is a key critical element in all market bubbles. To move along, Stage 4 crisis, for whatever reason, there's a brief pause in the acceleration and the euphoric attitude of the asset. Largely, I believe it's due to gross levered institutional investors that get a margin call. The bank says, okay, wait a minute, I've lent you enough money here. Right? And there's some event that triggers a pause in the price of the asset, and then it starts ticking lower, and then what happens? Selling begets more selling. And all those investors that invested in this area, either due to euphoria or worse, did so with leverage, now all of a sudden are getting margin called and selling, and that's when you have the throes in the fall of 2008. Those that painfully remember 2000, early 90s, you can just go back in time. So these are the 5 stages, the anatomy of a market bubble. And so the narrative, one of the big narratives, particularly right now, as markets are undergoing huge selling pressure the last few weeks, is we've got this market bubble. Market bubbles are sourced by some area of the economy that undergoes, well, one, that is systematically impacting everything, huge profit growth, and undergoes massive overinvestment by smart and then greedy investors. And so I'm not here to tell you that stocks won't continue to go lower or they'll go higher, but I'll ask you, what was the exogenous shock in the last 5 years? So maybe you could argue it was fracking, right, given what's happened with energy companies, given what's happening with the entire energy complex, and crude now with a 220 handle price on it, and I can't foresight or prognosticate the direction of it, but the massive amounts of leverage that energy companies undertook to get this product out of the ground as fast as they could and monetize it as fast as they could, that was probably an exogenous shock, but not really because it's too small. Energy is, I'm not an economist, but I don't know, 2%, 3% of our GDP. Energy is a big part of the high yield market, but it's not big enough. What were some other exogenous shocks? Well, a lot of investors, particularly bearish ones that are taking this bout of volatility to use that, to validate that their point. See, I told you we were in this market bubble. Well, was there a boom phase? And we don't have to go down far down the rabbit hole, but in my industry, and largely more so in the banking industry, huge, right or wrong, huge amounts of regulation came down the pike, following the 2008 financial crisis that largely was aimed at prohibiting the lending practices and the leverage that financial institutions could provide to the Wall Street community. So from my vantage point, the leverage ratios just aren't there to equate to a market bubble. But lastly, stage 3 euphoria. I would argue, this is just my belief, or what little that should be worth, but I can't find it. I can't find the euphoria, at least in the asset class I work in. So I spend the bulk of my time in the large cap growth universe, but I'll just maybe generalize it broader and say U.S. equities. So over the last 7 years, so at the peak of the financial crisis, from that point on through September of last year, the net capital that went in to the U.S. equity market was negative $2 trillion. So let me state that inversely. $2 trillion has left the U.S. equity market over the last 7 years. So in the 90s, you had bartenders giving you technology stock tips. In the 2000s, I literally had a friend of mine telling me about a company he was working with in southern Florida to flip homes. Of course, he lost everything on it. But in the last 10 years, this has been probably the most hated bull market, at least in my career. And I haven't been around long enough to provide anecdotal evidence if there were other bull markets that were more disliked. I guess I could just look at fund flows. But just given the absence of capital that's coming into U.S. equity mutual funds or U.S. equity products, I have a hard time sourcing the euphoria. But that doesn't mean stocks can go lower. Let me tell you and show you what drives stock prices. I'm going to check my phone just to make sure I'm on time. Okay. All right. So I built this slide out of anger and frustration. So when I mentioned that this is the most hated bull market, for the last 5 or 6 years, U.S. equities have lost market share to non-U.S. equities. So that $2 trillion that left the U.S. equity marketplace, it largely went to 2 places. Some of it went into credit, specifically high yield, that financed a lot of the leverage that took place in the energy market, but a big part went into European equities, Asian equities, and in particular emerging market equities. Largely under the notion, and this is just my assumption, because countries outside the United States are going to have higher rates of growth, right? The ramifications of what happened during the global financial crisis and the subsequent regulatory environment that we've been in is capping. It's going to lead to this subpar, weak, low interest rate, low growth environment for the U.S. economy. And that equates to low U.S. equity returns, which could not be any more incorrect. But that's how people think. They believe, they confuse correlation and causality. People do it in life all the time. I'll give you an example. So my daughter, you probably heard about the crazy snowstorms we got in Boston or in the Northeast last winter. Literally the worst ever. Literally. No, I'm not making that up. I was telling some folks at dinner last night, 14 feet of snow in 17 days. It was unbelievable. And it would start Saturday morning and sometime around Monday morning for 3 straight weeks. And so the 4th Saturday, where it wasn't snowing, my daughter said to me, "When's it going to start snowing?" And I said, "No, I don't." I wasn't paying attention. I said, "No, I don't think there's anything in the." She said, "Well, it's Saturday." Right? Correlation and just because 2 things correlate doesn't mean there's a cause and effect. So, regarding the economies, well, I want to invest in countries with high rates of GDP growth because that's what drives stock prices. I want to invest in China. I want to invest in Brazil because look at the growth rate in China 5 years ago. It was 6, 7x what it was in the United States. Look at the growth rate in Brazil. It's 3 to 4x. That's where I want my capital to be. All right, you would have lost a ton of dough if you did that. But here we go. Here's why. So what I did was we took the S&P 500 and we broke it down into 2 portfolios. Companies that make money and companies that don't. So a real simple exercise. So we look back every month end, looking back over the last year, the last 12 months. Every company in the S&P 500, companies that had positive trailing profits, they went into one bucket. Companies that had negative trailing 12-month profits, put them in another bucket, calculated the return of the two portfolios, and then rebalanced it, redid it monthly for 20 years. So this visual is a gross oversimplification, but I'm just trying to make the point that it's profits. It's profits, it's profits, it's profits, it's profits that drive stock prices. It's not GDP. Right? I'm not an economist, but GDP is made up of consumption, investment, capital expenditures, and government, imports, exports. Consumption makes up 70% of that. So GDP, from my perspective, is largely a proxy for population growth, or lack thereof, and consumer spending. The S&P 500, or the market, is a reflection of Uber, taking market share away from taxis. So you can see the red line. This is made up of a portfolio of companies who had positive trailing profits over the last 20 years. That portfolio would have been up almost 600%. Conversely, companies that lost money were down 30. Let me put it in these terms. 20 years ago, or over the last 20 years, the Chinese economy has quintupled. It's gone from 1 trillion to 5 trillion. Right? Massive, massive double-digit rates of growth. But if you had invested capital or a dollar in the Chinese equity market, it would be worth a lot less today. Conversely, if you invested in the U.S. equity market 20 years ago, it would be worth this. From a GDP standpoint, it was up, I don't know, 30, 40% cumulative term. So it's profits that drive stock prices. And so when I think about the market narrative the last 5 years, right, this is the most hated bull market because investors haven't been there. They've been in Europe, they've been in bonds that perhaps have done little or underwhelmed, or they've been sitting in cash. So it's easy to look at the market's at all-time highs. It's supposed to. It goes up 74% of the time. It's always going to be at all-time highs. And then to explain it away, it's easy to argue, well, this is just like 99. This is just like 07. I've seen this movie before. It's driven by profit growth. And the last comment that I'll mention on this, so why are profits so high? So if you take U.S. equities and compare it to any other asset class, any other equity asset class, over the last 5, 10, 20, 50, 100, 150, 200 years, you'll see superior profit growth and superior returns and superior risk-adjusted returns versus everything else in the world. Why is that? All right, do we have better innovation, smarter people, faster population growth, et cetera, et cetera? No. I'll source it back simplistically to one thing. There was a piece or document that was signed by King George 800 years ago, in the year 1215, called Magna Carta, right? The Great Rule, now more commonly known as the rule of law, the Constitution, respect to property rights. So what the United States possesses is it has a piece of paper that protects the rights of investors. And so if a company or an entity needs to adjust its workforce, it can. It can fire people. It can hire people. It can pick up its plant from California because it doesn't like the tax rate and move it to Texas. Or it can pick it up and go to Mexico. You've got capital mobility, labor mobility. And so what that results in is creative destruction. Businesses that can't succeed go out of business, and they get replaced by something better. Let me give you a couple of illustrations of this. So this chart is showing you something that I think all of us already know full well. It's graphing out the penetration rate of the internet for Americans. So how many of us were online in 1995? Well, it was about 1 out of 10. At the end of 2014, it was a little over 80%. I'm guessing that number's maybe something closer to 85 right now. But the point is the internet is fully penetrated. Whoever isn't online probably is not going to be online. So the internet is fully penetrated. So is this accretive to the growth rate of the economy? I don't know. No, I would argue it's deflationary. This is one reason why there's a lack of inflation. I'll get to that in just a moment. So the second thing I want to show you is, well, what percent of us are walking around with a computer that's more powerful than a mainframe computer 40 years ago? Right? Smartphone. Well, 1 out of 5 of us possessed one in 2009. Today, it's 2 out of 3. And when I update these numbers through 2015, I'm guessing it'll probably be something more like 4 out of 5. So the internet is fully penetrated. Mobile is fully penetrated. There's over 6 billion handset devices in the world, which is something more than the number of people that have access to clean water. And now, your mobile device, now you can call a taxi through Uber, you can change your flight, et cetera, do tons of different things. So, is this accretive to economic growth? No, but here's what's happening. This is now changing the dynamics and the profit pools in a variety of different industries. So from an investing standpoint, this is where you have to know where those cash flows are going and where they're coming from. So we just came off of the holiday season. I'm guessing many of you in this room did some, if not all, of your shopping online. It's easy, convenient, fast, etc. But 15 years ago, we weren't. So the percent of commerce that was electronic was nothing. Today, it's 8, 9, 10%. So e-commerce is taking share away from commerce. Translation. Online platforms, online shopping platforms are disintermediating brick-and-mortar retail. Creative destruction or creative disruption. So, I mentioned earlier, consumption is 70% of GDP. GDP for the US economy is, I don't know, 14 trillion, 15 trillion, give or take a trillion or two. So let's call consumer spending or commerce 11 trillion, give or take. So an investor focusing on GDP is going to make a retail investment decision based on if they think that 11 is going to 12 or if that 11 is going to 10. If you can predict that, then all credit to you. That's really, really hard. So instead of focus on it that 11 trillion is going to be up or more, you've got a huge, massive profit pool, and the share shift is taking place. So what's happening is the online platforms that have the value proposition that's attractive to you, that prevents you or prohibits you from going to the mall to shop at that brick and mortar retail, you're taking now share away from them. So there's huge, huge, huge profit pool shift. So understanding who the winners and losers are in this dynamic is incredibly important to your portfolio. Time. How do we spend our time? So this is just looking at minutes per day. This is globally. I should have done it for the US. It would have been more pronounced. But this is just looking at over the last 4 calendar years, how we spend our time. So 80 minutes per day, for example, was spent on the internet back in 2012. Through June of 2015, and these numbers are annualized, it was a little over 2 hours. So internet is taking, right, it's only 24 hours in a day, right? So the internet is taking share shift away from other things that my eyes would be focused on. Reading the newspaper, reading the magazine, watching TV, etc. You can see time spent on TV, 191 minutes per day globally. Now it's less than 180 minutes per day. All right, well, why is this important? Well, think about if you're an advertiser, right? If you're running the advertising budget for any small, mid, or large corporation, or think about your own organization, right? And I heard some of the speakers earlier today, right? And you're trying to attract perhaps other businesses or entities to come here and transact and do business. How do you want to reach them, and how do you advertise, and how do you think about reaching those potential customers and those eyes? Well, you have to think about this share shift. So the old adage for advertisers is that I know 50% of my advertising budget is wasted. I just don't know what it's wasted on, right? Is it wasted on radio? Is it wasted on television? Because the results are very, very hard to measure. So Chevy is advertising their trucks during the Super Bowl last year. Yeah, you have an idea how many people watched it. You have a good idea. You have a good idea as to what the male to female ratio was and if you're hitting your demographic. But I don't know about how you watch sports now, but I generally will watch games with an hour, hour and a half delay. So if the game starts at 1 o'clock Eastern Standard Time, I start the DVR going, and I'll go do something else. I come in around 2, 2:30, and then I'm blowing right through the commercials. Right? It's just too much. So, as an advertiser, you think about their share shift, it's anywhere from a $500 billion to $1 trillion industry worldwide. But 4 out of 5 advertising dollars still today are spent through these other traditional mechanisms. So there's this huge share shift that's taking place. And you think about, again, the online, if I'm spending more time online or I'm spending more time on my phone, if my phone or the advertising know that I'm standing in front of Starbucks, what can they do? They can ping me with a Starbucks commercial right then and there. And so this has huge, huge implications. Ben Carson, right, hoping to win the presidential or the Republican nominee, has 240 different Facebook ads that his team can target directly to those constituents where those ads would be most appealing to. So the online platforms provide not only targeted and directed advertising, but it's also pay-as-you-go. It's a la carte. So it's actually cheaper. Not only is it better, but it's cheaper. So there's huge winners and losers in this. I'll keep names out of it, but you get the idea. And lastly, over the top. So over the top, or OTT, is reference to how a new way to consume video content. So, for example, for those of you that own Netflix or HBO on the go or Hulu or Amazon Prime, what have you, there's a new way to consume content. So the linear broadcasting model historically has been content gets created, it gets packaged by the cable networks, distributed through a variety of different platforms, ultimately to the end consumer. And that bundle has gotten more and more expensive as time has gone on. But what's happened as mobile and the internet has penetrated, consumers are now consuming content on their phone, on their computer, and you've heard the term cutting their cord. I haven't cut my cord because I'm too lazy. I'm just absolutely too late. I'm too stupid to figure out how do I stream this and how do I get that, but millennials aren't. This is what millennials are doing. Thanksgiving, which probably like many of you, it's my favorite holiday. I go to my uncle's house. I only see him once a year. Actually, I see him twice a year because he comes to my house for Christmas. But I hadn't seen him in, I guess it would have been 11 months. At his house, great time, excited. We're going to have a football game on this TV. He's like, oh, what channel is it on? I'm like, same channel it's always on, 807. He's like, well, no. And he's fooling around with the rabbit. I'm like, are you kidding me? You're 65 years old and you cut your cord. He's like, I'm not paying that. And he's tech savvy, so he streams his content through these other devices. And his bill is, I don't know, $40, $50 instead of my $300 bill. But this is the dynamic. So is this accretive to economic activity and GDP? I don't know, but more importantly, who cares? Who cares? But what matters is who's taking share away from who. And ultimately, that's what drives stock prices. So let me conclude with, where's the investor euphoria? At least I don't see it. I don't see it at my firm as far as capital flows. I don't see it for the industry, and I don't feel it. Right? I'm not getting stock tips from the taxi cab driver taking me to the airport like I did in prior cycles. Investors constantly anchor to the wrong things. Right? They anchor to China's decelerating. Oil's at $28 a barrel. You know, I love it. The narrative was the opposite in 2007. How can the economy grow when oil's at 150? It's going to 300. Now the economy can't grow because oil's at 25. So I don't really get it. But they anchor to the wrong things. What matters is profits. Profits, profits. In technology, either directly or indirectly, it's now, I would argue, maybe that's the exogenous shock that's creating huge disruption in areas of business that typically were immune from this. And this is creating massive change in winners and losers, and stock picking, I think, becomes a lot more important, and the efficacy of it rises. So with that, I probably took up way too much time. Let me stop there and open up to any questions. First one's always the toughest. Yes, ma'am. Do I consider the Affordable Care Act being exogenous shock? That's a great question. I think maybe socially, yes, but from a market standpoint, no, it's way too small, way too small. So if a Republican were to win, hypothetically, perhaps it gets repealed. That would be accretive to certain aspects, certain areas of the economy from an earnings standpoint, but I think it's too small from that standpoint. But socially, yeah, probably right. Good question. There must be another one. Yes, sir, way in the back. Sure. For those that couldn't hear, perhaps on this side of the room, so 90 plus years ago with the invention of the mutual fund and innovative financial product, and maybe if I can rephrase, in the last 5-10 years, has there been maybe other comparable changes in the industry and ownership of whether it's individual investors or institutional investors? I would say from my perspective, the biggest change has been the growth of passive or ETFs, exchange-traded funds. So historically, ETFs have been 7-8% of the tape. So $100 of flow in out of the market, call it $10 of that, would have been through a passive vehicle. Last year, that number skyrocketed to about 36 cents or percent of the tape. So there's been a huge, huge growth in the basketization of risky assets. So biotech ETF, technology ETF, S&P 500 ETF. Right? And you see the commercials. You see the commercials on TV. So I think ETFs provide a phenomenal service because they give you instant market access to an area that you are seeking in a very, very cheap fashion, where I think perhaps they're being misused and overused is they're being used largely in many parts for trading vehicles. So the average, check this out, so the average holding period of a stock on the New York Stock Exchange through the 40s and the 50s and the 60s was about 15 years. Today, the average hold of a stock on the New York Stock Exchange is less than 2 years. So there's been this massive evaporation in time. So if you want to outperform the market, just be patient. Right? There's a time horizon arbitrage that the market affords you. Within ETFs, the average holding period of just a generic market ETF is anywhere from 4 to 7 days. So it's incredibly, incredibly short-oriented. So I think there's a place for both, but yeah, there's been such massive, massive parabolic growth in that area that I think it's creating market inefficiencies and dislocations for investors with skill to pick off and add value. Yes, ma'am. Did you, with Iran? Sure. The politics of that I'll keep out. Regarding oil, I think trying to anticipate the price, the future price of oil, is probably even harder or more difficult than trying to anticipate currency changes, GDP, et cetera. The reason is oil's not a free-flowing commodity, really, hence the core of your question. So when you start introducing policymakers and politicians and world leaders into the equation as part of something that contributes or detracts from the price of an asset, then it gets really, really hard to. So I can't anticipate what the Saudis, Iran, or Iraq will do from a production standpoint, because that's going to affect the price of oil. What I would just argue, or perhaps offer, what's happening right now is a vicious spiral is taking place. So I don't know what the right equilibrium is for the price of oil, but you had this huge supply shock brought on by new technologies. So here, right, creative destruction, business disruption, again, reaps its head. You have this massive, massive supply. Wall Street rewards energy companies by CapEx. So if you're spending money
to drill a hole. Wall Street reads that as, all right, you've got something in the ground that you're going to be able to take, sell, it's going to create cash flow. So Wall Street generally has priced energy stocks off of CapEx spend. So what does that signal to energy companies? I've got to drill. If I don't drill, Wall Street won't reward me. So they drill, and they drill, and they drill. And you need money, super expensive. Oh, I've got all these people that want yield products. I can just borrow from the debt markets. So now that what's happened, you had this huge, huge supply. The Middle East, beginning a year and a half ago, said, all right, we're going to undercut these guys. We're going to try to put them out of business. So the price of oil started falling. So here's what's happening. The price of oil is falling. You've got all these levered energy companies that the economics really don't work at $30, $40 a barrel. And so it's created this vicious cycle where, because they borrowed so much, now the leverage ratios are even getting worse, and it's creating this sort of, death spiral is not the right word, it's an overstatement, but it's creating this negative feedback loop. So ultimately, I don't know what the right price of oil is. I don't think it's necessarily a Middle East function. It's based on that equilibrium of supply, demand, and economic activity. But it's an area that was an exogenous shock, massive overinvestment, and empirically, energy stocks, despite their massive sell-off, are still the most expensive stocks. If you look at their valuation, they're still the highest PE stocks out there. So it's an area that's tough to invest in right now. Anybody else? Maybe I'll bring up our hosts. All right, thanks very much, folks.